You're listening to QSBS Solved, where we share insights for founders and investors looking to maximize their business's growth, exit opportunities, and tax savings. Our team at QSBSrollover.com offers specialized services to help you benefit from owning qualified small business stock. Our podcast guests are leaders in their respective fields and work on every side of the startup journey to help founders and investors win. The ideas and opinions shared here are not investment, tax, or legal advice. Reach out and we'd be happy to connect you with a qualified advisor or tax counsel. For now, enjoy today's episode. Hey everyone, welcome back to another episode of QSBS Solved. I'm here with Brian Lamb, who is the founder and CEO of Promissory, promissory.com. Brian, it's great to have you.
Great to be here, Brady.
Yeah, we collaborate in the QSBS space. There aren't many of us out there, but you're solving a problem that's a little bit distinct from QSBS rollovers, and it's really maybe one of the other major planning opportunities for founders who are potentially anticipating liquidity in the future, which is what all founders I think are looking at some level. So it's great to have you on, and hoping maybe you can just give some background about where you've been and what Promissory is, what problem you solve.
Sure. So I've been working in tech and startups, and specifically in legal tech for about the past decade. And prior to starting Promissory, I co-founded another company called Trust and Will, which is an online estate planning platform. And that company has done quite well. We've grown that to tens of millions in revenue, about 150 employees, there's about 80 million in venture, and just continuing to grow. And as part of that, and being a founder there, I was responsible for product and engineering and design and all sorts of aspects of just growing and scaling that product. And part of that was also growing and scaling myself. And so as a founder, one of the things that I like to focus on is hiring great people and handing off responsibility to them. And so I did that time and time again, all the way up to the point where I hired an executive team. I handed a bunch of things off. And then I got to the point of like, okay, now what?
I'm not doing anything.
So, it's kind of a dream scenario to build a machine like that can continue to run and build the systems with great people in place. But as a founder, you kind of get to this point of like, well, now what do I do? And so for me, that resulted in, I took some time off from business, took a sabbatical, kind of reevaluated things in my life at that point of like, okay, what do I want to do? And what do I want to do next? What do I really like to do? And so for me, that resulted in, I felt like it was time to step away from that business. And, it was a great, amicable exit, you could say. Worked that out with my co-founders. There was some secondary and things like that involved. And so as I stepped out of that business, I still have a very concentrated position in that business, which is continuing to grow and doing well. And I was looking at my equity of like, how do I plan for this? What are the ways that I can optimize this for the future? Because there's highly likely that there will be some level of exit or favorable outcome in that business, in the next few years. And so I started looking into all these different strategies, and they all kind of point back to QSBS. That's the best thing you can get as a founder to save on taxes in the long term. And of course, as part of that, one of the key strategies that I got introduced to was QSBS stacking. And so stacking is when you take some of the equity that you own in your business and you transfer it into a trust. And that trust is then eligible for its own QSBS exemption. So you're effectively stacking up your QSBS eligibility. And so this was really interesting to me because it's an estate planning tool. And I spent, almost the last decade building estate planning software. So I started digging into this and talking to attorneys and getting quotes for getting this set up. And the quotes I was getting back were, tens of thousands of dollars. Overall, all-in cost was like around $50K. And for me, that was really triggering. I was like, "What? Why is this so expensive? Like, what are you doing?" I spent the last, nearly 10 years building estate planning software that made the whole process more affordable, more accessible, and really, lowering the costs. And so more people could have access to it. But here's another one of those components that was still kind of gated by the high price attorney. And so I went back to the folks that I'd been working with on trust and law, the legal team that I built out there. I said, hey, is this something you can help me with? I'm trying to make these irrevocable trusts. And, overall, they're like, yeah, absolutely, we can help you with that. And so we started going down that process. And while I was doing this, I started reaching out to other founders in my network, just saying, hey, are you aware of this? Like, is this something you would do? What's your experience with this? And overwhelmingly, the response was, yeah, that sounds interesting. Like, I would like to do it. I just don't know where to start. And it sounds expensive. It sounds complicated. And like, I don't have time for that. I'm running my business. And so that was really a light bulb moment for me to say, we should just make software that helps founders do this, because so many people are missing out on this massive tax break, when they're building their business, and they just don't have access to it. And so that's why we built Promissory. And it just was built out of this personal need, personal exploration of saying, this needs to be something that more founders have access to. And so what we do is we help founders with the whole process of setting up the QSBS stacking strategy. So we do everything from trusts, drafting, valuation, and then Nevada-based trust custody. And we do it all on our platform for one flat fee.
That's awesome. We've talked about trust and trust stacking on the podcast before, but the question that we just continue to get, and it seems like no matter how much content we put out, it's like, well, when do I need to do this? And then is there a point in time in which it's too late to do this? So maybe walk us through like a typical founder journey, maybe raising venture capital and going through those stages. And I know that the answer, like high level, is as early as possible. But I also know that founders like to be in planning for the future. Sometimes they like to have some semblance of what the future could hold before they do that. So maybe you can take whatever angle you want into answering that.
Yeah, absolutely. So there's a few different ways to think about this. And, the conventional guidance is like, set this up as early as possible. But there's never really a good explanation of why. And so let's get into that. And then also, when is too late too, because there is a too late period for this. And so if you set this up earlier, you're actually transferring the shares out of your ownership to the trust at whatever the current value is of those shares. And so the earlier in your company, those shares are going to be much lower. The value of those shares is going to be much lower. And then the longer you wait, the higher the value of those shares. And the reason why that's important is because when you're transferring those shares to a trust for QSBS stacking purposes, it's actually a gift. And because it's a gift, allows that your QSBS timeline to transfer from your ownership to the trust. And so if you've already held those shares for 2 years, and then you're transferring at the 2-year mark, that timeline transfers to the trust along with it. And so you and the trust only have 3 more years to reach full eligibility. The other advantage to that is that because it's a gift, it comes out of what's known as your lifetime gift exemption. And so that's currently set at $13.99 million in 2025, and it is going to $15 million in 2026, and will be adjusted for inflation thereafter. And that was part of the changes that came down with the One Big Beautiful Bill. But why that's important is that's basically how much you can give away during your life or after your death that can be tax-free for your heirs or beneficiaries. Or any other gifting purposes that you want to use it for. And so if you're transferring at that lower price earlier on, there's going to be less of an impact into that. If you wait too long and you have a really high share price, you're like, I want to transfer $10 million worth of stock out of my ownership into a trust. Well, you're using up a majority of your lifetime gift, and sometimes you over it. And if you use up too much, you go over that limit, that's actually taxable to you as the donee, the person making the gift. And that gift and estate tax can be upwards of 40%. And so it really starts to cancel out the benefit of the strategy.
So married filing jointly, up to like $30 million then, under the new rules, 15 million for each.
Correct. Yeah, right. So
So
15 million per individual.
okay. Yeah. So let's use like that maybe 30 million number. Uh, does someone have to anticipate their assets growing to well in excess of 30 million to require a trust? Because, if I have maybe a $8 million exit in my business, and then, in my 70s, I decide to gift that money to my kids, do I actually need a trust structure to accomplish that efficiently?
Well, not necessarily. So I think one, you need to consider what you have in your personal ownership too, because in most cases, when you're issuing stock to an individual, especially as a founder, that's going to be issued to that founder individually.
Mm-hmm.
So not to both the founder and their spouse. And so you have one exemption for the individual at that point. Founder, when they're making that transfer, they're using up their individual exemption. Well, they may be still saving some under their wife's exemption or spouse's exemption, if you will. And
if
so,
if the company sells in the future and that money is converted to cash, which is just held, say, in my spouse and I's like joint estate, does that then fall? Understand what I'm saying? Does that fall under, at the end of our lives, we have X amount of assets together?
right. Let's assume that then those are combined together.
Yeah.
Right. So, founder gets those shares individually. They're then deposited into, let's say, a joint bank account that's part of their joint estate at that time. But I think the other part of the question was how much of that, like at what point do you need a trust for this?
Yeah, I guess what I'm trying to get at is how large, if I'm a founder, how large does my expected exit or like end of life wealth, like pot, need to be to justify trust creation or like these other structures? Because I know that, hey, I'm probably going to exceed this $30 million in gifting. And so, yeah, I'm trying to get to that number where, if I'm starting a small, a relatively small startup, I don't expect $1 billion exit. Like, is this still a strategy for me?
Yeah. So really this strategy comes into play if you think you might have an exit greater than 10 million.
Okay.
And so if you are going to max out your QSBS exemption and you want to then multiply it or carry that over, that's where the trust structure really comes into play. That's not to mention the new 15 million limit that was introduced along with the One Big Beautiful Bill. But the majority of folks that we work with are, have acquired their stock in the past, 3 to 5 years, and they still fall under the old rules. So really, if you have an exit north of 10 million, or the other thing is if you live in California, or, one of the states that doesn't recognize QSBS, then there's also some advantages to doing that as well, because all of our trusts are Nevada-based trusts. And so you have the benefit of both the QSBS exemption and no state income tax. But it is worth mentioning, if you are just pulling the proceeds back into California as for the benefit of a California beneficiary, then those are taxable at that time.
Yeah. So as a I guess example for our listeners, if you're a founder and you have an exit for, say, $20 million upcoming, you, at least under the old rules, would be entitled, as long as you met all the criteria, to a $10 million QSBS exemption on the federal level, which means you'd have another $10 million that would be subject to tax. But if you create a trust during that period before the sale, what you've now created, Brian, and correct me if I'm wrong, but is essentially another taxpayer in the trust, which gets its own $10 million exemption. So now you have your original $10 million exemption, and the trust has a $10 million exemption, which allows you to take that whole $20 million exit and take that federal income tax free if you meet the QSBS criteria.
Absolutely. Yeah. And so there's a few key distinctions on that too. A couple things we didn't cover too on timing. So the trust needs to be for the benefit of somebody other than you. And so it's an irrevocable trust and it's an irrevocable gift. And so the most common thing that we see is people will create a trust for the benefit of their spouse and one for their kids. Or you could do an individual trust per kid and really stack up those exemptions to, 10 million per kid, or you can create one trust for the benefit of multiple kids. And so it's kind of a shared exemption, or shared pot, across all of them. The kind of optimal time to do this for most startups and most founders is going to be in that seed to Series A range, where you've found product market fit, got something that's continuing to grow and scale. Like, you can see that there's going to be some likely event of a positive outcome at some point, but the share price is still relatively low compared to the overall potential value of what it might be, let's say, after you raise a Series B, C, et cetera, and you continue to grow the business. So it's really important to set this up at least 18 months in advance of that exit. That's kind of the ideal minimum range for getting this established. You can push that, but you just get into more potential risk of audit, and for that structure to be questioned and reviewed by the IRS. Really, you need to have some time between creating this trust and the actual exit or acquisition, because it needs to have some time to be established, be legitimized for estate planning reasons, and then you just happen to get the added tax benefit when that exit actually happens.
What does the timeline look like for bootstrap founders who aren't planning to go through the typical stages of raising venture capital? Is, say, a founder who isn't raising outside capital and so isn't having these price rounds, say they want to create a trust 2 or 3 years into the business, is there a valuation then that's performed at that time, and that's the share price, or do you use your 0.00001 cent founder share price to do that?
That's a great question. So, assuming this bootstrap founder is already a C corp and meets all the other criteria, and let's say they haven't raised any outside funding, there still would need to be some valuation performed on the price of the stock for the time of transfer. And that is a specific valuation that we do. It's called the gift and estate valuation. And it's similar to a 409A. It's a similar methodology, but it's specific to gift and estate. And so there are some, discounts and other criteria that go into that based on the size of the gift and so forth, that arrive at the ultimate price per share. And so that needs to be conducted separate from a 409A. So you have your 409A, which, marks the price per share for employee stock options. And then you have the gift and estate valuation for the purposes of gifting. And then that gets reported on your Form 709, which tracks your lifetime gift exemption. So you still have to conduct, both of these pieces to have, an acceptable value of that gift at that time, particularly for private company stock options.
Yeah, we all think that our businesses will get to a point where it nets us an exit above $10 million, or at least a lot of us do. And so I might set up a trust, but then I have an exit, but it's not, maybe that size. Maybe I gain $7 million and I have my own QSBS, and I also have maybe half of that stock or a portion of that stock went to my spouse, who's now holding that stock in a trust. What kind of flexibility do I have at that point for that money to be used in, flexible and I guess like liquid ways? What are the restrictions of having that money now in a trust if that's the outcome?
Yeah, so really comes down to how you establish the trust and what kind of rules and terms and conditions you put into that trust. So in the example of a trust for your spouse, in most cases, that's going to be the least restrictive type of trust that you would create. And so once there is liquidity there, they have the ability to take distributions from that trust. And those distributions are at the beneficiary's discretion. And so if they say, hey, I'm going to take all of it, great, you can take all of it. That would essentially collapse the trust and say, hey, the trust is worthless now. There's no money left. On the other side, where a little bit more planning and consideration comes into play, is if you're creating a trust for the benefit of your children. And a lot of founders that we work with, they have young kids. Like I have a 5-year-old daughter. So she has a trust that has specific conditions on, and she can access those funds. And there's age-based distributions that say, okay, X percent will be distributed to you at these ages. Common things are like 25, 30, 35. But then there's also exceptions for how funds can be accessed for the benefit of paying for education, medical expenses, health and wellness, things like that. And so you can have those exceptions in there as well that, in the suitable case, there's a liquidity event and, you want to access those funds to say pay for college, but they haven't reached that distribution age yet. They can go to the trustee and say, hey, I need a distribution for this.
Yeah. And so I guess to clarify again, if your spouse has, say, some of your shares, but that total value, the total exit value is under $10 million and, the QSBS has covered it all immediately. That entire $7 million amount is basically taken tax-free, even though a portion of it was in the trust, and it could be made immediately liquid right away.
It could, yes. Assuming that the terms of the trust match that.
I see. Yeah.
And so, that's just one of the things you need to keep in mind when setting up these structures.
And there are no distribution fees, penalties, things like that out of these trusts if they're not set up that way?
It depends. Generally, no. The way that most of our trusts are set up, we're just on a standard, like one distribution per year level schedule. And so obviously that can be more, but it really just gets into trust administration at that point.
There's, I guess you could think of this as planning for future life events like buying a house. Are there any benefits to owning property in trusts versus just owning them individually or personally?
Oh, absolutely. And, this is kind of one of the core things that we did at Trust and Well, because for most people who are creating a trust, or at least our standard revocable living trusts that we did at Trust and Well, which are different than the irrevocable trusts that we created at Promissory. But for those revocable living trusts, the biggest asset that most people own is their home. And so you want to make sure that that trust is titled into, or the home is titled into the name of the trust, such that when you pass, then that goes directly to your beneficiaries via the trust. Otherwise, it's going to have to go through the probate process, which can take years in some cases to clear up the ownership rights on that. And then meanwhile, that property is just sitting, a mortgage has to be paid, the access to the bank accounts are locked up because those also have to go through probate. So there are so many benefits to having your assets titled into a trust, particularly a revocable living trust that is going to go directly to your heirs and beneficiaries.
And the amount of your estate value doesn't necessarily impact those benefits. It doesn't sound like you can derive value out of having property in a trust, even if, say, your total net worth or total value of your estate is well beneath that $15 or $30 million.
Yeah. Really, the probate thresholds vary by state.
Okay.
But still, if you own property at all in most states, that's going to push you over that probate limit. And so you're going to want to at least make that consideration of, should I have a trust? And using a service like Trust and Well makes it incredibly easy to do that, not only for the trust creation, but then also the deed transfer and everything that goes along with that. So it's a pretty seamless process. No reason not to do it, especially if you own a home.
Yeah. Yeah, many, we're both in, obviously, a position among QSBS and providing services to help people maximize QSBS. What are some of the common questions that you guys get when founders come to you asking, from a QSBS perspective or like tax mitigation planning, those kinds of lenses, what are some of the common questions that you get, or whether they be just like purely educational or skeptical about the legitimacy, these kinds of things? Because what we're talking about is, sometimes pretty massive tax savings that people don't have a ton of knowledge about. And so it can feel, people might say, oh, too good to be true, or maybe this sounds too complex or indefensible, or is this legit? You can walk through some of those common questions, objections, or how you guys address that.
Yeah. So for most people, there's a little bit of education required that goes along with this. Introduction of the strategy, and then how does it work? Because you're right. In a lot of cases, it sounds like it's too good to be true. And so a lot of the questions stem around how do I transfer, and then how does that beneficiary then access those funds? One of the major things that we need to educate people on is when you're creating these types of trusts, it can't be for you. It's for the benefit of somebody else. And so do you have that beneficiary that you would want to give this access to? For most people, if they're married and have kids, this makes a ton of sense. If you're not in that situation yet, it gets a little bit more complicated. Because then, it's like, okay, is this a family member? Is it going to a parent? Things like that. And so we walk through some of the logistics around that, which really gets into, broader estate planning conversations as well. But for most people that, are married with kids, this strategy makes a ton of sense. Beyond that, it's, getting into some of the questions like you asked around, like, how are the funds accessed post a liquidity event? And then, what can we do with those? And are there additional tax consequences on top of that? So one of the things that we often get into is when there is a liquidity event and it's QSBS eligible, let's say up to the 10 million amount, that initial liquidity is the principal of the trust. And that principal of the trust is tax-free up to, with the federal and the state limit, especially with the Nevada trust. But then if those funds are invested and, they continue to grow, then you have basically cap gains on top of that. And so, when you're looking at distributions, you can balance out distributing from principal versus distributing from, any other gains or income on top of that as well. One of the other components with this type of trust structure is it's a directed trust. And so that means that there are roles that you need to appoint within that trust. Not only you have a trustee, but also an investment advisor. And so depending on the strategy that you take here, especially with us, whether it's just a completed gift non-grantor trust or it's an intentionally defective grantor trust, you have different options for who can serve in that role. If the trust is defective, that means you retain some of the rights to the trust and it's not a completed gift. And that works well if you have kind of a longer term horizon until that liquidity event, and you want to retain some of the control over those assets. You essentially, from a trust perspective, you retain the powers of substitution, so you can swap assets in and out of there at an equal or greater value, which is what makes it defective. It's still technically owned by the grantor, but it's outside of your estate for tax purposes. And so you still get the advantage of transferring those assets at whatever the low price is that they are today. And so some people look into that really just for gifting purposes as well, of like, how do I maximize my gifting ability to transfer assets to my children, but still retain some control over it, particularly serving as investment advisor. And so the investment advisor is one of the other roles in the trust. So grantor can serve in that in certain conditions, like if it's a defective. And then later stage, it's really advisable to have a full wealth manager, especially if it's someone that's going to be in it for the long term. With a children's trust, where this might be sitting in trust for decades, you don't want to miss out on the benefits of compounding
there. Yeah, that's great information. I guess one last question is if I'm a founder, I've already exited my business, I've been dabbling in some other things, maybe working on side projects, or maybe I went back to kind of standard W-2 work. I'm just living my life post-exit. Is there an opportunity to set up these trusts, obviously not for QSBS benefit, but just for estate planning benefit in general? Is Promissory then a place that folks can do that? Or back at Trust and Will, what's sort of where would you direct that person?
Sure. It really depends on your goals. If you just want to set up a standard revocable living trust, Trust and Will is going to be your best option for that. Which, you're going to put your house and other assets into that have the benefit of passing directly to your beneficiaries. If you're looking for more kind of longer term tax planning, and especially QSBS optimization, Promissory is a great option for that. Particularly if you're looking to transfer assets outside of your estate into a trust for your beneficiaries. If you think you may be getting to the point where you're hitting some of those lifetime gift exemptions and you want to transfer things from your estate into your beneficiaries before they kind of hit that limit, we're a great option for that. And so really our core strategy and our focus is really designed on helping founders pre-liquidity optimize their tax position for that post liquidity exit. But there are other use cases that we cover as well.
Very cool. Yeah. So just to recap, I mean, QSBS maybe hands down the most generous tax exemption available in the United States, not just for entrepreneurs or for founders, but just like one of the most powerful tax planning tools in the country. And the two really main strategies that exist out there that have sort of like structure around them are this trust stacking strategy and QSBS rollovers, which we do a lot of. So for trust stacking, mainly going to be looking at benefit for QSBS on exits in excess of $10 million, or in future years, it will be above $15 million with some of the changes that were made. And can be a great complement if you have a really large exit, say above $40 or $50 million. QSBS rollovers and trust stacking together can be great complementary strategies when you have massive exits where maybe you're running out of trust to create or you run out of rollover businesses to start. They can accomplish some of the same benefit for really large exits. So it's a great strategy to keep in mind alongside rollovers.
Absolutely. And especially, I'm excited to see what happens in, a couple of years from now as we start seeing people exit in that 3 and 4 year timeline as well. And the things that we can do not only to help maximize that with trust, but then also as a great opportunity for rollovers as well, because you get a little bit of liquidity and then you can plan for the rest of it, at the same time. It seems to be the best of both.
Yeah. Awesome. Thanks so much, Brian, for coming on and sharing. Where can, obviously, folks can go to your website, promissory.com, but outside of that, is LinkedIn the best place to find you and get in touch directly?
Yeah, absolutely. Promissory.com, book an appointment with our team. We'd love to chat with you about the strategy. And then, feel free to reach out direct on LinkedIn as well.
Cool. Thanks, Brian. Hope to talk to you soon.
All right. Thanks, Brady.
Thanks for listening to this episode of QSBS Solved. We hope to hear from you soon. Remember that the content shared on QSBS Solved is for informational purposes only and should not be construed as legal, tax, or investment advice. While we discuss strategies related to qualified small business stock, or QSBS, including rollover planning, listeners should consult their own tax, legal, and financial advisors before making any decisions. Laws and interpretations can change. Individual circumstances do vary.